The employment report for June was just released today, and it was weak. A lot weaker than the financial media are suggesting. I've dug deep into the numbers released today, and in this video, I'm going to explain why today's employment data could prove to be quite consequential for Fed policy, the economy, and financial markets. First, let's review the headline data. Non-farm payrolls grew by 206,000 jobs during the month of June, which was a little bit better than the 191,000 expected. However, a big factor this month was that the data for the months of April and May were drastically revised downward, and we're going to talk about that a little later. So the net surprise this month was actually quite negative. Average work hours and average hourly earnings were roughly in line with expectations. But the unemployment rate ticked up a little bit from 4% to 4.1%, which is a little bit higher than what was expected. Let's dig a little more deeply into the payroll data. The first thing that I want you to look at is the percentile rank of the 3-month rate of change. It's at around 32%, which is significantly lower than the historical average. And this is decelerated significantly compared to the 6-month rate of change, which is at the 42nd percentile. Now, the second thing I want you to focus on is private non-farm payroll growth. And what we see here is that on a 3-month basis, we're at about the 30th percentile rank in terms of the growth rate, which is significantly below the historical average. And that has decelerated pretty significantly from about the 36th percentile during the last 6 months. So what we see is a pretty big deceleration in overall non-farm payrolls, but that's being led by an even stronger deceleration in private non-farm payrolls. The only thing that's holding these numbers up a little bit is government payrolls, which this past month grew at a rate which ranks in the 78th percentile. So that helped boost the numbers both on a 1-month basis and on a 3-month basis. On a 3-month basis, government payrolls are growing at around the 51st percentile, which again, compared to private payrolls, which are growing at roughly 30th percentile, it's a lot stronger growth. And so it's government payroll numbers that are actually holding up the overall numbers. And that's something to really take note of. Let's now focus on the attribution analysis for the data this month. First of all, we'll see that total non-farm payrolls decelerated by about 12,000 jobs. But here's where it gets interesting. Total private payrolls decelerated by a very large amount, 57,000 jobs. So the actual payroll number, if it had just been private payrolls, would have looked pretty bad this month. But the numbers were boosted by the fact that government payrolls accelerated by 45,000 jobs this month. So that sort of helped save the day, so to speak. Now let's look a little bit deeper here and let's look at what happened in private payrolls. And what we see here is that it was professional and business services that led the charge in terms of the deceleration. And when we move over to the household survey, this particular survey that we're looking at right now is the establishment survey. But by looking at the household survey, one of the things that we see is that we had a big loss in terms of temp help services in the professional services sector. And that's actually a leading indicator in the economy. When companies stop hiring temp help or start letting go of temp help, that's a pretty strong indicator that the economy is starting to weaken. So that's something that's actually very notable in the data today. So here's another thing that was very notable about the payrolls report today. The data for May and April were revised down quite sharply. For example, the data for May were revised down from 272,000 to just 218,000 jobs. And the data for April were revised down from 165,000 to 108,000. That's a total downward revision for those 2 months of 111,000. Now, that compares to the positive surprise that we got in the June data of about a 15,000 job positive surprise. But as we can see, the downward revisions of the data for the prior 2 months completely overwhelm the positive surprise that we got in the June data. And we got to remember that the June data is probably going to get revised downward as well. For well over a year, we have been getting consistent downward revisions of payrolls data almost every month. So here's the bottom line for the payrolls data that was released today. When you include the revisions for prior month's data, we got a net negative surprise, and it was a very substantial net negative surprise. So let's review what this means for the overall economic outlook for the U.S. economy. If today's numbers would have come in roughly as expected, the 3-month growth rate of payrolls would have been at approximately the 39th percentile. As it is, because of the downward revisions, we're at the 32nd percentile. So this represents a fairly significant deceleration in terms of payroll growth. Now, the consequence of this is going to be that GDP forecasts for the second quarter are going to come down substantially. And the fact of the matter is that GDP forecasts have been declining precipitously. At the beginning of the quarter, GDP now by the Atlanta Fed, which is a nowcast, was forecasting growth of above 4%. Their latest reading before today's data was already down to 1.5% for the second quarter. Now, after these employment numbers, this is going to come down even further. This type of deceleration is going to cause people to worry about the soft landing scenario that the market has been expecting. When the economy decelerates from 4% down to 1.5%, that's actually not bad. The Fed actually wanted the economy to decelerate. But if the economy continues to decelerate any further, then we're going to start getting close to growth numbers that are going to get people worried about the possibility that instead of a soft landing, we might actually get a hard landing. Now, I think these really soft employment numbers combined with a bunch of other soft data during the past 2 months is really going to catch the Fed's attention. I think members of the Fed, many of them, are going to start to worry that the economy is slowing too quickly. And so I think there's going to be increasing pressure within certain members of the Fed to actually start down the path to lowering interest rates. This was a path that they've already been preparing the market for, and it's just a matter of time before the Fed starts cutting interest rates. And I think this data today is going to push them a little closer to finally pulling the trigger on making their first rate cut. The Fed funds futures market is expecting the first rate cut in September, and I think that's about right. As long as we don't see any acceleration in the inflation rate, and we continue to see a little bit of deceleration in the inflation rate, then I think that the Fed is going to finally pull the trigger on its first rate cut in September. And we may actually get one other rate cut before the end of the year if we see any continuation in this tendency for the economy to slow. Let's transition now to considering what this means for financial markets. First of all, I think for Treasury bonds, this is clearly very good news. Treasury bonds perform well when the economy slows down. And in particular, TIPS, which are Treasury inflation protected securities, should do particularly well due to the downgrade in growth forecasts. Now, for the equity market, the picture is more mixed. Equities also like it when interest rates are falling and when there's an easing of financial conditions. However, slower economic growth also means slower earnings growth. And the market right now is expecting extremely fast earnings growth. So we could be facing a potential disappointment in terms of earnings growth expectations, and that is actually negative for the equity market. So the picture for the equity market is somewhat mixed. Now, there are two other considerations that I want you to keep in mind in terms of the equity market. The first is market breadth. Market breadth in the past few months has been absolutely terrible. And poor market breadth has historically been a leading indicator of a weak stock market, and it's also been a leading indicator of weakness in the economy when the bad breadth happens late in the economic cycle. I just recently published a video, which I'm going to place a link to in the description, which I really encourage you to watch. In that video, I explained that really bad breath late in the economic cycle is generally a sign that there's a lot of imbalances in the economy. And the correction of sectoral imbalances in the economy tend to play a major role in the unfolding of a recession. Now, the second thing that I want you to keep in mind right now is the vulnerability of the U.S. economy to an oil price shock. In my latest video, and in several other videos that I'm also going to link to in the description, I've talked about the fact that I think that there's a pretty high probability that we're going to get a major oil price shock in the second half of this year. And generally, U.S. recessions get triggered by an exogenous shock. And the most common type of exogenous shock that triggers recessions is an oil price shock. So I'm going to be very closely following developments in the oil market during the next 6 months. The U.S. economy is currently growing at a rate of less than 1.5%. So if we were to get an oil price shock right now, that could very well push us into a recession. This concludes my presentation on today's employment report and its implications for the economic outlook and for financial markets. Now, I want to hear what you think. Please leave your comments and your questions and suggestions in the comment section. I'm really interested in what you have to say. And most importantly, click that subscribe button, because in the next few weeks, I'm going to have some really interesting videos.